90% of all startups fail. To understand why this collapse is so consistent, we have to look past the top-line numbers and into the structural mechanics of a crash. The mythology of the modern founder is incredibly seductive. We see the headlines about unicorn valuations, overnight billionaires, and massive venture capital rounds raining down on college dropouts. This chart shows the survival rate of a new startup cohort. 20% fold within their first 12 months. By year 5, 70% are gone. For first-time founders, the trajectory is steeper. Only 18% build a surviving business on their initial attempt. This creates a strange paradox. These companies are often built by brilliant engineers and backed by millions of dollars from top-tier venture capital firms, yet they consistently crash. These collapses are almost never sudden accidents. The structural flaws that tear a company apart are often built into the foundation on day one. Researchers call this the liability of newness. A new organization faces its highest risk of failure in its earliest stages, often making compounding errors before a product is even finished. Two specific errors dominate this early phase. Teams often engage in a false start by building massive infrastructure without customer discovery, or they struggle with co-founder conflict, which accounts for 23% of early deaths. Quibi stands as a prominent example of a false start. Led by Jeffrey Katzenberg and Meg Whitman, the company raised $1.75 billion while leaning on its Hollywood elite backing. They spent years developing a premium platform for watching short videos on the go. However, they ignored mobile media habits, launching a commute-focused app in the middle of a pandemic when consumers were primarily at home. The company shut down in 6 months. While 38% of founders claim they simply ran out of cash, this chart shows what happens when we crack that number open. Inside that figure are the actual operational issues: poor team dynamics, pricing issues, and a lack of market need. Research across hundreds of failures reveals a consistent pattern. A startup's burn rate tends to expand to match its total funding. Whether a team raises $1 million or $10 million, they typically find themselves with the same 18-month runway. The more capital they have, the faster they spend it. Running out of cash serves as the final, visible signal of a company's demise. By the time the bank account hits zero, the underlying operational issues have usually been active for months. The most frequent killer is a lack of product-market fit, which accounts for 42% of all startup deaths. It happens through a predictable psychological trap. Founders fall in love with their proposed solution and stop obsessing over the customer's actual problem. Consider Juicero. They raised over $120 million to build a $400 Wi-Fi-connected juicer. The machine was a marvel of high-tech engineering. Then came the reality check. Consumers quickly realized they could squeeze the proprietary juice packs with their bare hands more efficiently than the expensive machine. This chart visualizes a speed trap. When founders inject massive marketing budgets to rapidly scale a company before proving anyone wants the product, they only accelerate their own destruction. There is a persistent myth that aggressive competitors act as assassins. The data shows that competitors are rarely the force that takes a startup down. Customer indifference is more dangerous. Scaling a product without a clear market need turns venture capital into a liability. In these cases, massive funding simply accelerates the burn rate, leading to a much faster, more expensive collapse. To perform an accurate autopsy on a failed startup, you have to look past the date the bank account hit zero. The true moment of death occurs months or even years earlier. It is triggered when founders refuse to pivot, ignoring blaring warning signals like high churn rates and apathetic users. The 10% who survive behave differently. Successful founders explicitly budget both their financial and psychological runway to accommodate 3 or 4 complete pivots. They prioritize early validation. They test their ideas with potential customers, verifying the demand long before they build any massive infrastructure. They shift from relying on investor sentiment to relying on the market. While venture capital represents a belief in potential, consistent revenue from paying customers provides proof that the business model actually works. Most failures result from the compounding effect of ignored feedback and echo chamber development. These companies fade away over months of optimization on a flawed model. As the lights go out, remember, Failure doesn't happen instantly. It builds silently. We constantly see the shocking headlines in the news about massive, multi-billion-dollar startups that just seem to collapse overnight. This animated diagram illustrates the brutal math of the industry. Out of 100 new companies, 90 of them turn red and eventually vanish. And of those failures, 70% die within a tight 2 to 5 year window. The public often attributes these high-profile deaths to a sudden market crash or a stroke of bad luck. But if you look inside the companies, you rarely find a single fatal accident. You find systemic internal rot that was ignored for years. This timeline maps the final days of a typical failed startup, a phase called death flailing. Following their final funding round, the central resource bar drains over exactly 20 months, ending in insolvency. The leadership remains highly active during this period, but nothing they do is actually fixing the core problem. Startup mortality is highly predictable. When you dissect the data from hundreds of failed companies, you find a specific architecture of failure that unfolds in 3 chronological stages. The first stage dooms the timeline right from day one. According to industry postmortems, 42% of startups fail for one simple reason. They build a solution for a problem that doesn't actually exist in the market. Founders frequently fall into a psychological trap. They spend their days obsessing over their product's features, writing code and perfecting the design, entirely forgetting to check if a customer actually needs them. Take the company Juicero. They raised $120 million from top investors to engineer a sleek, Wi-Fi-connected juicing machine. They shipped the product, and then consumers realized a fatal flaw. You could take the proprietary juice packets, squeeze them with your bare hands, and get the juice out faster than the $400 machine could. The machine worked perfectly on a technical level. The failure was a miscalculation of human behavior and actual market demand. Stage 2 occurs when a founder takes that flawed product from stage 1 and pours massive amounts of capital into scaling it. In the late 90s, a company called Webvan decided they were going to revolutionize grocery delivery. They spent millions building out an enormous physical infrastructure, including this massive fleet of delivery trucks. They committed a critical error, building complex, nationwide infrastructure before proving profitability in a single local market. This graph plots the LTV/CAC squeeze. The upper line, customer acquisition cost, trends upward, while the lower line, customer lifetime value, stagnates. In this widening gap, the metric imbalance is clear. The cost to acquire a user is far higher than their generated revenue. Premature scaling destroys these companies because founders are scaling the abstract idea of a massive business, rather than a mathematically proven business model. That unchecked scaling leads directly to stage 3, the terminal phase of the life cycle. There is an absolute rule regarding capital in the startup ecosystem. A company's burn rate will always expand to match its total funding amount. If you raise $10 million, you will inevitably find a way to spend $10 million. Even as the internal numbers decay, founders at this stage project supreme confidence to their investors. Adam Neumann and WeWork illustrate this perfectly, masking massive structural losses behind charisma and aggressive physical expansion. Leadership points to vanity metrics. They highlight their growing headcount or top-line revenue to justify their continued spending, while completely ignoring their toxic unit economics. When the bank account finally hits zero, the founders say they ran out of cash. But running out of money is rarely the actual cause of death. It is simply the final symptom of ignoring the market for too long. Startup failure is the compound interest of bad decisions. It requires a long chain of missteps, from building the wrong product to scaling it too fast, and finally burning the cash reserves to hide the math. The 10% of startups that actually survive do so by actively contradicting the popular advice to grow at all costs. They prioritize harsh reality metrics over vanity metrics. They look at customer retention and acquisition costs. They pivot quickly when the objective data tells them they are wrong, and they maintain strict capital discipline. Surviving founders refuse to rely on cascading miracles. They do not base their business plan on the assumption that 5 highly unlikely external events will all go perfectly according to plan. Failure is a scientifically predictable outcome of ignoring market reality. Survival, on the other hand, is a deliberate choice.